Welcome to Her Money Revolution. I'm your host, Angela Brooks, your guide on this journey to becoming a wealthy woman. As a certified financial planner, owner, and advisor at Family Capital Management, I'm on a mission to simplify the conversation around investing and to help women generate more wealth by making their money work for them. Join me as we navigate powerful financial planning strategies to help you achieve your personal and professional goals. This podcast is your go-to destination for no fluff, easy to implement financial and investing advice. If you are ready to achieve audacious financial goals, dream beyond boundaries, and generate massive wealth for you and your family, this podcast is for you. Grab a notebook. Let's get started. Hello, and welcome back to Her Money Revolution, the podcast where we empower women to grow their wealth by making their money work for them. I'm your host, Angela Brooks, and today we're continuing our Investing Toolkit series with a topic that's all about getting paid while you invest, and that is Dividends 101. If you've ever dreamed of earning money without having to clock in and clock out, dividends are your new best friend. In this episode, I'm going to break down what dividends are, how they work, and why they can be a powerful tool for building wealth and generating passive income. If you're ready, I'm ready. Let's dive in. So what are dividends? Dividends are payments that companies make to their shareholders, which if you own the stock, you're a shareholder, and it's usually from the company's profits. So think of them as a company's way of saying, wow, thank you for investing in us. And they're a fantastic way for you to earn income without selling your shares. Most dividends are paid in cash, but bear in mind, some companies do offer dividends in the form of additional shares, and that's called stock dividends. So how do dividends work? Well, there's key dates that are very important to understand. And those 4 dates are, the first one is the declaration date. This is the day that the company announces it's going to pay a dividend. The next date is the ex-dividend date. This is the most important date for you. In order to receive the dividend, you must own the stock before this date. So listen, it's important to understand the ex-dividend date because you've got to make sure that you own the stock prior to that date in order to get paid a dividend. So if you want to take advantage of the dividend, be sure that you own the stock at least 1 day prior to the X date, and then you'll be all set. You'll be able to get paid that dividend. The next date that you want to be mindful of is the record date. This is the day that the company reviews its books to determine who is eligible for a dividend. So the record date is going to happen 2 days after the ex-dividend date. All it means is that you as a shareholder and all the other shareholders that own the stock have been recorded to receive their dividends. And lastly, we all just want to get paid, right? So that last date to be mindful of is the payment date. And that's the magical day that you'll get paid and that the money is going to hit your account. So why do companies pay dividends? Companies are going to pay dividends that are companies that are financially stable. So why would a company even pay a dividend? It's a great question. Companies that are financially stable and profitable often pay dividends because they want to reward their shareholders for their loyalty, or they want to attract investors that are looking for a steady income stream. It also signals financial strength and stability in the company. Those are often reasons why a company is going to pay a dividend. There are different types of dividend stocks. There's many, actually, different types of dividend-paying stocks, but I wanted to just give you a handful. So here's 3 common categories. Blue chip stocks. These are large, established companies with a history of paying consistent dividends. So think like Coca-Cola or Johnson & Johnson. There's dividend aristocrats. These are going to be the S&P 500 companies that have increased their dividends annually for at least 25 consecutive years. So this consistent dividend growth reflects a company's financial stability and their commitment to returning value to you as the shareholder. So think Procter & Gamble or think 3M Company. The third common category is going to be your high yield stocks. These are stocks that pay higher than average dividends, often from sectors like real estate or utilities. So think of a Realty Income Corporation or think Duke Energy Corporation are examples of high yield stocks. One of the best ways to build long-term wealth with dividends is through a dividend reinvestment plan, also called DRIP. Instead of cashing out your dividends, you use them to buy more shares. Over time, this compounds your returns because you're earning dividends on dividends, right? That's the power of compounding. So here's why they are so effective, and here's how they work. So instead of receiving your dividends as cash, a DRIP automatically reinvests them into purchasing additional shares or fractional shares of that same stock. So that means that every time you receive a dividend, you get more shares. Those new shares also generate dividends in the next payout cycle. And then over time, this snowballs your number of shares and the total dividends that continue to grow exponentially. That, my friends, is the power of compounding. So DRIPs are great. They're a great fit for you if you are a long-term investor. You're not needing this income now, but you still like to have dividends, positions that pay out dividends, but you can keep them invested, right? DRIPs are a great fit if you want to maximize your compounding growth. Also, if you're more of a hands-off investment approach, then using that DRIP is a really, really great strategy to continue to growing your wealth. Again, if you need immediate income, you wouldn't want to use the DRIP strategy. You would prefer receiving dividends as cash, right? Instead of reinvesting them. So while dividends are great, there are some things that we need to be cautious about. We want to be careful with chasing high yields. A very high dividend yield could be a red flag. It could be that the company is actually struggling. So a high dividend yield can look incredibly attractive. You know, who wouldn't want to receive 8% dividend or a 10% or even 15% on their investments? I know I would. That'd be super great. But before jumping right in, it's important that you understand that a very high dividend yield can sometimes truly be a red flag rather than an opportunity. High yield should also prompt deeper research on your part. Understanding if it's the golden opportunity, this is a great investment, or is this a warning sign that there is trouble ahead in this company? So don't just chase after high yields. Another thing to watch out for is dividend cuts. So a dividend cut occurs when a company reduces or eliminates its dividend payments to you as the shareholder. It often happens as the very last resort for companies that are facing those financial difficulties. However, it could also be a strategic move that the company does to preserve cash, possibly for future growth. But when a company cuts its dividends, a few things happen. So stock prices drop. So as an investor, you're often going to view a dividend cut as a sign of weakness, leading to sharp decline in the stock market or in the stock price of that company. It also could mean that there's a loss of income for you as a shareholder. If you're relying on dividend income, let's say you're retired and part of your income is what you receive from dividends, this would mean that you need to adjust your portfolio. You need to look somewhere else for other companies, other positions that are paying dividends. It could mean as an investor, your confidence could decline. So dividend cuts can signal financial instability in the company, and that makes us nervous about is this a good long-term company to stay invested in? And then if not, or if that fear of that, it could cause more investors to sell out of that stock, sell out of the company. And then that would reduce the overall price of the stock. Some real life examples of dividend cuts. General Electric is a great example. In 2018, before that, they had a strong dividend for years. They were paying strong dividends. And then they cut their dividends by 92%. General Electric cut their dividends by 92% in 2018. And it was due to financial struggles and debt problems. And it never came back, right? So that was one this is a red flag. In 2020, there's a handful of companies that suspended or eliminated their dividends. Ford, for example, they suspended their dividends during the pandemic, and they said it was to conserve cash. Disney also eliminated their dividends in 2020. Parks were closed. It was COVID, right? Nobody could go and do anything. So they stopped paying dividends. Now later, they reinstated it. I think it was in 2023 that they reinstated it. So that was a red flag if you were a short-term investor in Disney, but that's something where it's like, okay, well, there's outside circumstances that created that dividend to be eliminated for that time period. Disney's still a good company to be invested in. I still own Disney for a longer-term investment. Another thing to be really mindful of, another risk that you want to watch out for with dividends, and this is a big one, is taxes. So dividends may be taxable to you. So you want to understand how they impact your tax return. The amount that you pay in taxes is going to depend on the type of dividend that you're in, your income level, and then where those dividend funds are coming from. What investment vehicle are they in? So a qualified dividend, for example, is a lower tax rate. So qualified dividends are paid by U.S. companies, and they meet specific IRS requirements. They're taxed at long-term capital gains tax rates, which are the lower tax rates. They're lower than the ordinary income tax rates. So long-term capital gains, that's where your income matters. You're either paying 0%, 15%, or 20%, those capital gains taxes, depending, again, on your income level. Or dividends could be ordinary dividends or non-qualified dividends, which is a higher tax rate. So these dividends do not meet IRS requirements for the lower tax rates. They're taxed at your ordinary income, meaning they follow whatever your regular tax bracket is. So if you're in a high tax bracket, let's say you're paying 37%, you're going to pay 37% on ordinary dividends. So understanding your tax bracket is important as well. Then there's tax-free dividends. These are municipal bonds, or some other types of dividends could be tax-free, but mostly muni bonds. And they're exempt from federal. And then depending on the state, sometimes and oftentimes your state taxes as well. So how do you know what you have or what you're invested in? And so at tax time, you're going to receive a form 1099 div. This is going to come from the brokerage firm. So wherever you're custodied, wherever you're holding the investment account. So I use Charles Schwab. So I'm at Charles Schwab. So if I'm in a taxable vehicle and I have a stock that pays a dividend, even if I'm reinvesting that dividend, I will receive a 1099 div from Charles Schwab that is going to show how much I earned in dividends and whether they're qualified or non-qualified. So you want to be careful when you come tax time, when you start receiving some of these tax forms. Some ways to reduce dividend taxes. So when we manage the investment portfolio at my company, we're really mindful of, if you're in a qualified account or a non-qualified account, and making sure that we have the right investments within each of those vehicles. For example, if you hold dividend stocks in your tax advantaged accounts, meaning like a Roth IRA or a traditional IRA, dividends grow tax-free. So you never have to pay taxes on any of those dividends, right? But if you're in the traditional, then they're going to be deferred until retirement, right? In your traditional IRA. So if I buy a stock and it's in my Roth IRA and it pays a dividend this year, I don't have to worry about it. It's tax-free. Doesn't matter. Same with a 401k or a simple IRA. Dividends aren't taxed until you start taking those funds out. which is different than if you're in a brokerage account or a trust or a taxable vehicle, that even if you don't take money out of that account, if you're not taking a withdrawal from that, but the dividends are paying, you're still paying taxes. So you really want to ask your advisor, if you have one, what your tax implications could be depending on the certain stocks or investments that you're purchasing. Another way to help reduce taxes is that you want to focus on the qualified dividends. Stocks that pay qualified dividends can help lower your tax burden compared to the non-qualified dividends. And then this is another question for your advisor. If you have one, you want to do some tax loss harvesting. So if you do have capital losses, you can use them to offset some of your taxable dividend income. Invest in tax-free income funds. So muni bonds and then certain ETFs, they do offer tax-free dividends, which make them really ideal for high-income investors. So if you're in that high capital gains bracket, but you want to have exposure to a muni bond, looking for those that have the tax-free income is a great opportunity for you. I personally love dividends because they're one of the best ways to make your money work for you. I often talk about having another stream of income, and this is that. Dividends can become another stream of income. If you think about it, you're getting paid just for owning a stock, right? And the best part is that you can use that income however you want to. Maybe you need a little extra cash flow, or maybe you want to reinvest those dividends and buy more shares and let your money continue to compound over time. Either way, the dividends are still a really, really great tool that every investor should know and love and understand. The more you understand, the more you'll probably love them as well. So high level, a few takeaways from today. Dividends provide a steady stream of passive income from your investments. Reinvesting them can supercharge your long-term growth because you're earning dividends on dividends on dividends. That is the power of compounding. And the real secret is that if you focus on quality companies with a history of substantial dividends, you're gonna do great. That is how you make dividends work for you. That's all I have for today on my episode of Her Money Revolution, the Investing Toolkit series. I hope you feel empowered. I hope you feel ready to add dividends to your investing toolkit. If you found today helpful, please share this with a friend, subscribe, leave me a message if you want. And don't forget that wealth is built step by step. Every dollar invested brings you just one step closer to that big financial goal that you have. Until next time, believe in the power to build wealth and bless others along the way. I look forward to seeing you next time. Thank you for joining me today, and I hope you are feeling more empowered in your financial journey. Remember, follow and subscribe to Her Money Revolution on your favorite podcast platform, and share your feedback by leaving a review. I'd love to hear your biggest takeaway from today's episode. Until next time, stay inspired.